Hello. This is the third screencast for Chapter 2. This particular screencast, we're going to take a look at Problem 2.13, which can be found on page 81 in Fraser and Ormiston's Understanding Financial Statements. In this particular problem, you're going to use the information that they provide in the book for Zebra Technologies consolidated balance sheets and statements of income for December 31st, 2013 and 2012, and then the valuation, and you're going to analyze accounts receivable and allowance accounts for all years. And so what I've done here is I've set up an Excel spreadsheet, and all I've done is taken the information that was provided in the book and I set it up in a spreadsheet. I like to do that because it makes it easier to work with. And so what they've provided us here is, again, this comes from net sales. This obviously comes from their income statement, right? So we have net sales in 2013 of $1,038,159. And then we also have 2012 of $996,168. Again, they specifically state that the amounts are in thousands, so you would have to add 3 zeros to get the real information. Then they have accounts receivable net, which comes off of the balance sheet, and so for 2013 it's 176,917, and then for 2012 168,732. This schedule below is actually part of the 10K. And I'll actually show you this for Mattel's 2018 in another screencast that I do to go over the Mattel assignment. But this is found towards the end of the 10K report. And this kind of gives you a reconciliation for each year. So it goes back 3 years and gives you kind of a summary. So the beginning balance in the allowance for doubtful accounts in 2011 was $1,459 or $1,459,000. What they did is they had bad debt expense of $343 or $343,000. That's what the charge to costs and expenses column means. And then deductions, $242 or $242,000 in what they call deductions. These would be the write-offs. They're actual write-offs. So charge to cost and expenses is your bad debt expense. Deductions is the actual write-offs, because when you write off, you're writing off the account against the allowance for doubtful account. You've already taken the expense and bad debt expense as an estimate. And then the balance at the end of the period, and of course, it becomes the starting balance for the next year and then works its way through. And we'll talk about these results in a minute. So I created a main page here called Info, which just lays out the problem information. I then solve the problem on another page. So I have Analysis. And so it's essentially a duplicate. Don't know why that was there. This is just a duplicate page here. And so, but notice I've got some things highlighted and some things colored. Again, I told you this column here represents bad debt expense. There should be some bad debt expense every year. So this was odd to me. So I highlighted it to call it out to myself. The other thing I noticed is look at the high number of deductions to the account, and then the ending balance for the period. It drops sharply from one period to the next. That's odd to me. That's very, very odd. And so we'll be able to talk about that in a minute. I went down here and I calculated their gross receivables amount. Okay, and so all I did here was add the cells. I added the amounts here. I wanted to know what their gross receivables were. So for 2012, it's 168,732 plus the amount in F10, which is $669. You add those together, you get 169,401 for 2013. You do the same calculation. 176,917 is added to F9, which is $453. And so that gives us our gross receivables. Now we can go ahead and calculate some changes. So we have up here a change in net sales. The change in net sales is 4.2%. And again, I used a formula to calculate that. So I took this minus this. So we did have a growth in net sales. We also had growth in an increase in our accounts receivable net for the period. And so we have total AR is 4.7%. And again, look at the formula here. I took the gross amounts here. I wanted to calculate on the gross amount of receivable. And then I looked at the allowance account. Look at the allowance account change, negative 32.3%. If you're an analyst or you're an auditor, this is going to be quite odd to you. You expect to see net sales and accounts receivable move with each other, but you expect to see the allowance account also to kind of change in unison with these. These should all be in lockstep with one another. The fact that, again, I showed you up here, the fact that there was nothing charged to bad debt expense, that you've got a declining balance going forward in the allowance for doubtful accounts, while you're having increases in sales and increases in receivables, they're actually estimating they're going to collect a greater proportion of their receivables going forward. And without a specific reason why they think they will, that could indicate a problem. And then the percent of receivables, notice that it's changed. It was 0.39% in 2012, 0.26% in 2013. So that percentage is definitely going in the wrong direction. So I red flagged these items here because that is changing. And typically what you would see is that percentage would typically stay about the same. Because again, it's based on an estimate, it's management's estimate. The only reason that you would change it is if management's estimate changed, and that would have to be something you would need to look up. Again, does it mean that something's going on here? No, not necessarily, but it is something that needs to be addressed. Now, I think it's important to remember, again, what you're dealing with here is you have the gross accounts receivable, that's less the allowance for doubtful accounts, which is a valuation account. Net accounts receivable is being reported as net realizable value. That is the valuation technique that's being employed. And the income statement effect is bad debt expense. And that's part of the estimate, the valuation. When they actually write off an accounts receivable, okay, they reduce the accounts receivable account and they go ahead and debit the allowance for doubtful accounts. That's the deduction for the allowance account. Because if you think about it here, it makes sense. We have an asset account here. So the gross accounts receivable is an asset account. It is a debit balance account. That means the allowance for doubtful accounts has to be a credit balance account because it has to offset to get to a net amount. And so the amount in the allowance account is netted against the accounts receivable or subtracted from gross accounts receivable to come up with the net amount. The other thing you need to know is, where does the estimate come from? Well, the estimate is from management, and management bases it on things like past experience. They may have an estimate based on an overall, this is how much they typically collect out of every dollar that's owed to them. Also, knowledge of their customer quality. So the people that they're extending credit to, if they can understand the quality of the customer and what their payment history is, so they can drill down to individual customer levels. The overall state of the economy. So this is kind of from micro, where we're looking at past experience and customer quality at the micro level. Now we're looking at macro and looking at the state of the overall economy. And the last piece that they would actually use would be like the firm collection policies. And that would be something, if you notice a drastic change like we're noticing here, where the percentage of the allowance to the receivables is changing, which it shouldn't. This could indicate a change in their credit policies or their collection policies. And so you'd want to look at that. And again, the actual losses, the actual bad accounts are written off against the allowance account. That's what goes on here in the deductions area. So this is bad debt expense. This here is the write-offs of actual accounts that have gone bad. Okay, and again, this is peculiar here. And so that's the first thing I noticed. And this would be the second thing. And then you've got the decline in the allowance account, which matches the change here. Okay. Just to kind of go over a few points here. The reason why you would look at accounts receivable is you want to make a judgment about earnings quality. So in this case, without knowing anything else, without having any other additional information, the quality of this firm's earnings might be called into question, because it could be that they're attempting to manipulate earnings. So we're looking at the ratio of allowance to gross receivables. That's this percentage here. Okay. We're also looking at the percentages of change. Okay, because we want to understand how it's changing, and we want to know the direction of the change and the magnitude of the change. And so right here, that's what we're noticing. We had an increase in sales and an increase in accounts receivable. They're pretty close to one another, although that 0.5 percentage point can be a significant amount. But the allowance account is one, it's a magnitude issue and a direction issue. And then you can see it here in the ratio. Okay, and again, this information here is Schedule 2, Valuation and Qualifying Accounts. It comes from the 10K report, and it's one of the schedules that's included towards the end. So that's how you would work through this problem. And so those are kind of the things you would want to highlight in writing up your analysis. This is what you would want to show, and these are the things you'd want to address. You'd want to address the fact that they had no bad debt expense in 2012, that they did have write-offs in the year, so that's odd in and of itself. You've got a declining allowance account balance here against increased sales and increased accounts receivable. And then we have the rates calculated here so we can see it more clearly, and then we have the ratio. So those are the things you'd want to touch on and explain. And you would kind of go into a little bit of detail, but not much. I would venture to say that a correct response to this question could have been done with a well-written paragraph. Okay? So